hybrid cash balance plan. It is going to work in some ways more like a 401k style plan, which I think you're probably all familiar with, but it does still preserve attributes of what's known as a defined benefit plan. So that's where the hybrid comes from, is because they borrowed features that generally make up 401k style plans, which are called defined contribution plans, but they also preserved parts of defined benefit plans when they established the plan. So we'll talk about how it works, when you're eligible, and all those kinds of things, and you guys just fire away any questions that you have as we kind of are stepping through this. I do want to add, we are a couple years into the plan, and we have a little bit more information now than when we originally did the books that you guys have. We are in the process of redoing the Tier 3 book, and it just has quite a bit more information in it. Most of that we have already put online, but the print book itself is still being batted around for review, and it should though be available. I think it was due to go to the printer. So within probably the next month, if you guys were interested, you could get a hold of the new Tier 3 book. And there, again, there's a little bit more information in there since we're now 2 years into it. So you guys are part of KRS, which Kentucky Retirement System actually administers 3 different retirement plans. You guys specifically are under the CERS plan, which stands for County Employees Retirement. We also have the KERS plan and then state police plan. So depending on who you work for, that's going to govern what system that you pay into. CERS is going to cover pretty much city, county, any local government type entity. And there are over 1,500 individual employers that make up CERS. So here in Owensboro, you know, there's the city, Davis County Fiscal, the water company, OMU, the Riverport. There just are any number of agencies here, just even in Davis County, who are part of CERS. The school board, they're all part collectively of CERS. KERS is going to be pretty much straight up state employees. And then there are some quasis. So as an example, the state universities, with the exception of UK U of L, their staff also pay into KERS, as do the state employees. So depends on who you work for. That's going to govern which system you're part of. And then, well, then of course, state police, as you can imagine, that's just the uniformed troopers. That's who's part of the state police system. So we have all 3 of those under the KRS umbrella, okay? Now, if you were to change jobs, let's say you went from here to work for the state, you would then be contributing under a KERS plan, but for your specific accounts, you're basically just continuing to accumulate like you always have. It's just you're under a different plan at that point. But as far as we would look at the accounts basically as if they were one in determining what your benefit would be and then when you would be eligible for retirement. So in other words, there's reciprocity available to you guys if you change jobs, as long as you're still with a public employer paying into one of the systems. That's also true with the teachers' retirement system. There's an independent teacher system in Kentucky, and then there's also an independent legislators and judicial system. So there's actually 6 state systems, and that reciprocity goes across all 6 of those. So if you decide to run for the legislature, and now you're a legislator or a judge, you know, all of that would still work together. So again, just a little bit more detail on the difference between what you guys have versus what your coworkers who are in the tiers 1 and 2 have. In a defined benefit plan, the benefits get determined, get calculated based on a formula. Now their formula is different than your all's, but that's still true for you guys, just like it is for them. Your benefit is based on a formula. Your formula happens to be your accumulated account balance, and then that number, that value, is divided by an actuarial factor that's going to correspond with your age when you retire, okay? So we're actually going to look at what your account, the balance of your account at the end of the road, and that's not something we do with the Tier 1 and 2 folks. You have the cash balance plan resembles a defined contribution plan. for that very reason. It determines your benefits based on the value of the account. But again, going back to how it's calculated, that's where the defined benefit piece kicks back in. Additionally, guys, just like everybody else in tiers 1 and 2, this plan does provide a life annuity. So at the point that you qualify for the retirement, and we'll talk about when that happens, you are eligible to be paid a benefit as long as you live. So, most of us are going to outlive our actual account balances, and that probably will be true for you guys as well. But because of the type of plan you have still, you continue getting a check for your lifetime. Okay, so you still have that benefit, the defined benefit piece where it's a lifetime annuity once you qualify for the retirement. Okay, so just some differences. You guys have 2 numbers with us. You have a PIN number, which is a 4-digit, and a member ID. Member ID is basically your account number with us. You all should have gotten a new member enrollment packet when you were first enrolled, when you first contributed to the plan, and along with that, you should have gotten a letter that contained your 4-digit PIN. I know usually when I talk to people, they're like, "Oh, okay." So if you don't have any clue what you did with that information, the way you would get a new PIN is you just simply need to call us, and we will mail you a new letter with that 4-digit PIN number on it, okay? The PIN can be reissued over and over. Now, the member ID is not going to be as critical for you guys. Member ID, again, it's your account number, but we use it where possible in place of social security number. So that would be like on a form. So let's say you had to do, I don't know, maybe you needed to update your beneficiary designations. It's going to ask for your member ID instead of your social. Member ID you can get, you can log online to your own individual accounts and get your member ID. But to log on to your online member accounts, you're going to need your PIN to do that. So PIN's always going to be a little more critical of a number for you guys. But just, again, awareness is that we actually have assigned 2 different numbers to you guys. So you guys, just like everybody else, you pay a fixed amount of 5% of your gross salary to your own individual accounts, okay? You guys also contribute 1% of your gross salary into the health insurance fund. Okay, that does not accumulate in your all's individual accounts. That 1% contribution was actually enacted by statute back in 2008. So anybody who's come on board and started participating since September of 2008 pays 5% to their own account, and then 1% goes right to the health insurance fund. Again, it does not it doesn't accumulate into your all's individual accounts. So you actually are paying a total of 6%, but you're only realizing 5% of that in your individual accounts. Now, the employer contribution number that you see here is the full percent that the employer pays to CERS based on your gross salary. Now, you guys work different than 1s and 2s in that you all receive an employer match of 4% of that dollar or of that percentage. So they're required to pay 17.06% on you guys, but your 4% of that is actually deposited into your individual accounts. So each month, you're paying yourself 5% from gross, you're receiving a 4%. We don't actually call it a match, we call it an employer pay credit. That's the term that the retirement system has given to it, but it's basically the match. So you're getting 9% each month based on whatever your salary was for that month. Those are your base contributions, member and employer, okay? Now, you guys additionally, in this plan design, are automatically credited at the end of every fiscal year. The plan design awards you a 4% base interest credit on your account balance at the end of every fiscal year. Now, that doesn't technically start until the end of year 3, because the interest, and again, this is true for everybody, not just you guys in 3, interest is based on the preceding year's balance. So at the end of year 2, I jumped ahead. At the end of year 1, your preceding year's balance is 0. So you don't technically get the interest until the end of year 2, and then that's based on the prior year's balance. So this June 30, 16, which just rolled through, 4% will be credited based on your June 30, 15 balances, okay? I know everybody, you're looking at me like, what? So it's just, that's the way the interest is credited. So you guys automatically get 4%, whether investments go up, investments go down. You have zero risk there. It's always based on plan design, balances at 4%, cumulative interest over time. So you're always gonna get that base level 4%. You have zero risk of loss here because, again, of the plan design. That's base. Now, additionally, there's something called upside sharing interest. However, because we have this new information, I always forget it's there, I jump ahead. So this chart just simply shows that effective compounding interest over time. And this chart just shows somebody, it's a $35,000 salary over all the years. This simply shows the accumulated balance based on the 4% interest credits. So even with nothing else being paid but that 4%, you can see how over time, with your 5 plus the 4% credit, you see how that money is accumulating. And this is a simulation over 25 years. So that's, just the base account growth, how it's going to grow. Further, there is something called upside sharing interest. Now this interest credit is only paid to you guys if our investments exceed a certain benchmark. And the investment return has to exceed 4% because you're automatically given the 4% base. So this interest credit is only going to be paid if and it's actually it's a net return. The technical term is this thing called geometric average net investment return. So it's the return over the prior 5 years. So that's going to be a rolling average from fiscal year to fiscal year because it's going to include the prior 5 fiscal years. Now that we're beyond the 08 and 09, we're seeing the geometric average net return go up a little bit. Last year, the upside sharing interest that was paid was an additional 3.77%. So Tier 3 balances, if you had a balance as of June 14, last year in June, you would have received a total of 7.77% interest credited to those balances. The 4% base plus the additional 3.77 upside sharing. So this one is going to fluctuate, and if the net return doesn't exceed 4%, it won't be paid at all, but you're always guaranteed that base 4%. Okay, so far so good, guys? I don't know what it is this June 30, 16. It's too new. We don't have the numbers in yet to know what the geometric return was for this past year, but we'll have that pretty soon. Generally, by the time that we close a fiscal year out, we have to run a bunch of different year-end jobs. We're talking late August, early September before the interest is actually applied and credited to your account. So here in the next couple of months, you guys will see those interest credits show up on your individual account balances, okay? So here's a depiction of the actual way it works, because I know I said 3.77%. The way that upside sharing is actually calculated, we look at the excess above 4%. And this example assumes a net return of 7.5%. So we back out the 4% you guys automatically get. That leaves a balance of 3.5. The plan design says you guys then qualify for 75% of that, which in this example translates to 2.63%. So that plus base would get you a 6.63 return. Last year it beat that, and it was a 3.77% return, okay? So that's what we're looking at as we go forward. So this year, the net will include 16, 15, 14, 13, and 12, those last 5 fiscal years, okay? So to sort of summarize, this is how your accounts are gonna grow over time. The member contribution of 5%, the employer pay credit of 4%, the base interest of 4%, which is paid to both of those balances. And guys, those are kept separate. Your portion and the employer portion, those are actually kept separate on the accounting side of things. Technically, you're not going to qualify for the the employer portion until you guys invested, meaning paid in for 5 years. And we'll talk a little bit more about that in just a sec. So you got 5% you pay yourselves, 4% employer match, the base interest credit of 4%, plus the upside sharing interest if that's paid. Everybody with me so far? That's how your accounts are going to grow and accumulate over time, okay? And we have a chart that will show you another sort of projection on how those balances will grow. this is when you guys are actually eligible for that annuity. And that's gonna happen, you guys are considered non-hazardous, that's gonna happen at age 65, or gonna happen when something called Rule of 87 happens. Rule of 87 says you have to be 57 years old, and that your age plus service has to equal 87. So if you're 57, that would mean you need 30 years of service. 57 plus 30 equals 87, you meet Rule of 87. So you qualify for the annuity once you meet one of these two criteria, whichever is gonna come first for you, okay? You guys always have the ability to just leave the accounts intact, and if you're vested, so you've done the 5 years, which is required at 65 for the annuity, you could park it at 55 and come back to us at 65 and start the annuity then, okay? So again, how we calculate is gonna be, here's your formula. Your accumulated account balance, which includes those 4 different pots of money, divided by a factor when you retire, okay? You guys only see a couple examples of factors in the books you're looking at. I think it's maybe page 9. If you guys look at maybe page 9, what is that page you're on? Is that 9? Yeah, okay. So what you see on page 9 of those books, and it's the top 2, because the bottom 2 are hazardous. Those are 2 different, well actually 4 examples of the calculation. So we've got, let me get a book so I can play along. The top shows 3 examples at age 65. So a 20-year, somebody who paid in 20, somebody who paid in 15, somebody who paid in 10. Again, one of your options if you ever leave employment, you can always just leave your accounts intact, walk away from them. They will continue earning the 4% base interest credit every year. Even though you're not contributing anymore, you're gonna still earn 4% base interest every year on the balance of the money. The upside sharing interest stops once you're no longer contributing and active. But you're always getting that 4%. So the question you have is, can you roll this money somewhere else or put it somewhere else and to continue getting a guaranteed 4% return on it? So maybe the answer is yes, but that's one of the things that you guys would want to kind of think about before you would roll it out into something else. Okay. So what you're looking at are basically 3 different scenarios, different balances, but the formula, if we apply it, it's the balance, in this case, the age 65 factor, it's divided by that factor, and that yields the monthly annuity amount. That annuity amount you guys see is the lifetime payment. So again, you're going to get that no matter how long you live. So if you've already been paid back your full balance, that's where the benefit of the defined benefit piece of the plan kicks in. You continue receiving that check as long as you live. Which if you were in a straight up 401k plan, once your balance was gone, that's it. You're not going to be able to draw anything more off of it. So that's one of the benefits you guys still have with this Tier 3 plan. The second example shows a Rule of 87 example. So we've increased that balance substantially. You'll notice that the actuary factor is higher because of the younger age. But it's the balance divided by the factor, and that yields the annuity amount. Okay, so you guys are actually really simple when it comes to the determination of your monthly benefit. The tricky part is getting to your balance, at the end of the road, what's that going to look like? And again, it's always going to be 5% of member, 4% employer, 4% base, plus the potential upside sharing interest. So what we've done with the new information, we've actually populated all the factors, and then we've got some additional examples that we've included too. So we've tweaked those examples that you see in the book a bit and changed that around a little bit, but here you still get the same idea, balance divided by factor. I have mentioned a couple times that you guys can roll your money out if you opted to do so, if you quit your job. I've also mentioned that you can let it, you can leave it. The downside to withdrawing it is that if you are vested, so you've done 5 years, you opt to withdraw your account, whether you have it paid directly to you or you roll it into another qualified account, both of those are options. Once you're vested, it includes that employer portion. The IRS treats that as a pension distribution. And because it's considered a pension distribution, technically that means that you guys retired. And so even if you're 25 years old, but you take a refund that's made up of more than 5 years service, so you're eligible for the employer money, we would have to treat you like a retiree if you ever came back to work, which would mean you could not pay back into the retirement account. So a vested refund, which includes the employer portion, would prohibit you from ever being part of the retirement system in a future employment capacity. Now, if it's a non-vested refund, you've got your 5 years in, you're only going to be eligible for the member portion, and that, if you came back to work for somebody and were part of the system again, you could repay that, okay? So the biggest consequence is once you're vested, taking it out prohibits you from ever paying back into the system should you land back, at a job where the employer is part of the retirement system. So it's a lot to consider, before you make that decision. I don't have any good advice on that. I had some folks who, CCU is actually in the system, but they're taking advantage of a law which allows them to stop participating. And so, all their Tier 3 people are faced with a situation where they're only going to have 2 years in. So they're not vested yet, but I think most of the people I individually spoke with have decided to just let the account sit, continue, banking their 4% interest because they want to preserve their ability, to potentially get back in. Of course, in that situation, they still would be able to get back in because they're not vested yet. But a lot of them are like, why roll it out when it's going to at least continue getting the 4%? So you just, you'd have a decision with what to do, with the money. If you're old enough, you could go ahead and start the annuity. But for you guys, that means you're 65 years old. So kind of make some sense.
Yeah, you don't even get that much on a CD or a savings.
You generally
account.
don't. So you'd have to think about that. Yeah. And this is just a depiction. Somebody who did 10 years. They started at age 30. They left at age 40. So we came up with a balance, and then we just applied the 4% to it going forward for 25 years. So we got them to 68.1, and again, we do the math, and that still yields an annuity of $562.87 for their lifetime. So, it is kind of what it is, even for you guys. It's defined benefit still to where it's formula based, and we just can't do a whole lot to manipulate it. I mean, what we pay into it is fixed at 5%. So, it just kind of is what it is. It's one of those things, you cross the bridge when you get there, should your employment situation change. It's just a matter of what's that benefit going to be worth potentially if I leave it alone and leave it sitting there versus if I wanted to roll it with me to my new employer. Yes?
Can you draw that and Social Security?
Absolutely.
Okay, because somebody told me you couldn't.
Now, you guys pay Social Security taxes, right?
We do not.
Oh, you don't?
Full time.
I did in a previous job as well.
Well, then, so you would be subject to the windfall elimination provision potentially, but if you have, they reduce your offset depending on your years of significant earnings. So 30 years, if you have 30 years of significant earnings, how Social Security classifies that, it's going to be less of an offset. You can still draw your Social Security, but yes, there would be an offset.
They said if I was 66, that it wouldn't, drawing stuff doesn't affect me.
Well, that's a Social Security provision, so yes, I would listen to whatever they say. That's what little bit I know, but yeah.
Subject to change.
Yeah, I have 2 years of zero. I worked in another state and didn't pay Social Security taxes, so I'm not going to be subject to the offset because I didn't qualify for a pension on that time, but it affected my years of earnings because I have 0 years for that period of time. So it just depends on your individual earnings record with Social Security as to the amount, if at all, that they offset you. But it doesn't prevent you from drawing it. It's just you may be drawing a reduced amount from Social Security if you qualify for a pension based on work not covered by Social Security, just like the teachers. So yeah, I didn't realize you guys didn't contribute, pay Social Security taxes, yeah. So everybody be potentially looking at that offset through Social Security, unless, again, you have enough earnings to offset the offset, so yeah. So again, guys, if you do choose to take a refund, basically it's broken down into a vested versus a non-vested refund. A non-vested refund would be before you have 5 years in, and that would just be made up of the member 5%, the member base interest, and then the member upside sharing interest. So only the interest that's applied to the member portion. You wouldn't qualify for any of the employer 4%, the employer base, and the employer upside sharing. That would kick in once you have the 5 years, and then it would be the entire account balance, which again is why we kind of maintain those buckets of money separate up until you're vested, and then you qualify for all of it. Refunds may always be paid directly to a person. If we do cut you a check, we have to withhold 20% for the federal government, and then refunds are also always eligible to be rolled into another qualified plan. So if you're going to work in the private sector and they've got a 401k, you can roll it right in without being subjected to that 20% withholding. Again though, a vested refund, because it includes the employer portion, that's going to be treated as a retirement distribution, so it would preclude you from ever being able to participate in the future if you got back into work for somebody who's part of the system, which is crazy, I think, but that's the way our outside tax counsel, they've looked at it every which way, and that's still the way that our tax counsel is telling us we have to implement this. Can you leave your benefits to someone? Absolutely, everyone should have done a retirement beneficiary designation for their retirement account. You do that on a Form 2035. You can name a principal as well as a contingent beneficiary to the retirement account. Again, until you guys would be vested, if something happened to you, it would just be the member portion of your accounts that would be eligible to be paid back to a beneficiary. Once vested, it would be the full account balance, just like you guys would qualify for it if you terminated, would be available to your designated beneficiaries. And then when you do ultimately, some point down the road, retire, you have a group of options called they're called retirement payment options, where you can actually leave that retirement check to a designated beneficiary, once you go through that retirement process. So you can actually perpetuate that in retirement if you choose a survivorship option, where that money, you would have that money continue to be paid on to that beneficiary. So at the current time, you guys just want to make sure that whoever you've designated, is who it should be, and then just keep in mind that, if you have life situations that occur, you get married, you get divorced, you have children, whatever the case may be, that you update those designations as needed with the retirement system. You guys do have a health insurance benefit. Your health benefit is actually the same as your Tier 2 coworkers. The health benefit requires that you retire with a minimum of 15 years. So it's a different service requirement than just the pension piece of it, which only requires 5 years at 65. Health benefit, to have that paid, requires 15 years of service, so 180 months. The way the health benefit is determined is the years of service that you've contributed are multiplied by a specific dollar amount. Right now, that dollar amount is $12.80. So it's your years of service multiplied by $12.80. So if somebody had 30 years multiplied by that dollar amount, it comes out to around $400, say. That's what would be paid toward the cost of your monthly health insurance plan. So you've got the pension piece of it, you've got the health benefit piece of it, and then you guys also have something called a death benefit. Everybody has this, not just you guys. It's a $5,000 lump sum. We don't consider this life insurance. It's literally a lump sum payment. When you do retire, you designate a beneficiary for this benefit. So you've got your annuity, you've got your health insurance benefit, you've got your $5,000 death benefit. And that pretty much kind of encapsulates sort of the benefits you have through the retirement system. Now, there are disability benefits that would be available, but those are not going to be available until you're vested. So, and that again, that's true across the board. Everyone has to be vested to qualify for a disability benefit. Disability benefits would be calculated a little bit different than everything we've looked at today, but that is something else that is a benefit, or I guess it's not really a benefit, that's the wrong word to say. It's a plan option that would entitle you to your retirement benefits should you become disabled before those Rule of 87 and age 60 or 5 requirements that we looked at earlier. So you do have some additional options there if something were to happen to you. All of your account information, guys, is available online. You need that PIN number, like I mentioned earlier, to actually access the accounts. That's the good news. The bad news is you guys don't have a very good calculator built yet. So when we were looking, at those numbers earlier, like I said, getting to a projected balance, when you're 65 or when you meet rule of 87 or in 10 years or in 20 years, whatever you might want to project, they've not built a calculator yet that will actually do that account balance projection. The only calculator that's available to you guys right now, simply, it forces you to put a balance in and then it does the rest of the math for you. So it basically takes your balance, divides it by the factor for the age, and then it shows you all your different options. You guys need a calculator, which, you start from today, here's my balance, here's my salary, and you project out that balance in, again, 10, 15, 20, 25, 30 years. That's the number you really need to get at. I've actually had some people build their own spreadsheets to do that. We've tried to utilize that and put it on our website, but we can't lock that form down securely. So right now, that's kind of the bad news, is you guys don't really have a calculator which will get you to your balance unless you take that upon yourselves and do it yourself. They will have that calculator in another couple of years, but right now we have so many things that we have to implement because of new legislation, tax things and all this other stuff, that our IT folks are absolutely swamped. And as much as I've begged and pleaded, because I'm out talking to Tier 3 people all the time, please, 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 can we have a calculator? They've just finally said, Amy, there's no way we can get that done until, what they're looking at time-wise is once you guys would be vested, they'd have the calculator done by then. So that's the bad news, is that you don't have a calculator. Again, going back to what I told you guys earlier, it is fixed at 5%, so it's not like you're making a decision, well, what if I put in 2 or 3% more, because that's not an option for you guys. But I think if it were me in your shoes, what I would be thinking about is what potentially is this benefit, in, again, 10, 15, 20 plus years. How much do I need to be saving supplementally in addition to this? And that's where I'd want to know, should I really be trying to put away 2%, 3%, 5%, 10%? Of course, most people would say put away as much as you can, but some of us work better with defined numbers as far as, I know I need to put away another $150 a month or whatever to reach this goal. So again, there are calculators available on the internet that will do all that for you as far as projecting your balance out. But that's, I guess if it were me, that's kind of what I would be looking at. I did want to show you, I kind of brought up the wrong slide deck, guys. I did want to show you, I think it's in this one, the Tier 3 got a pretty bad rap when it first came out, that it was a worse plan. And now that we've had at least 1 year with the upside sharing interest, we did some projections. So let me show you guys this. I don't know what's, oh no, come back. That's not what I wanted. Full screen. Am I missing some? That go away. Mac sometimes doesn't cooperate with me. What is that?
If you push that arrow to the right, the little triangle in the middle
Oh,
there.
thank you, good Lord. Okay. So, there was a lot of misconception that this plan was really terrible compared to the Tier 1 and 2. Now, it may not measure up to the Tier 1 calculation, but what this exemplifies, Tier 2 and Tier 3, if you look at the Tier 2, this is a 25-year service career. Okay, so somebody's been in for 25 years and then they're getting their benefit at age 65. You see the Tier 2 calculation based on the formula we would use there. The end result is basically $1,093 a month, okay? The Tier 3 person with just base interest making the same salary as the Tier 2 person for all those years comes out to a $1,084. So they're within $10 of the pension calculation. Now, if you look at the second Tier 3 example, that one, we've assumed that same upside sharing interest that was actually paid last year for the 25-year period. Now, is that a reality? Probably not. That assumes that, we hit that investment marker for 25 years in a row. But if you apply the 7.77% interest instead of just the 4% base, that gets you up to $18.41 a month. We have an investment rate of return of 7.5%. That is our benchmark. So what the bottom example shows, if we just hit our investment benchmark, that would result in an upside sharing plus the base of 6.63. So as long as we hit our mark, that would get you to $15.61 a month. So this slide is just simply to demonstrate the differences between the pension calculations for each of the tiers. And with you guys, we have the 3 different examples: base interest only, base interest plus what we paid last year upside sharing, and then the third is the base plus if we hit our performance goal on the investment side of things. So you guys, with that upside sharing interest potential over the long haul, very well have the ability to exceed the pension calculation over your Tier 2, and in some cases even over your Tier 1 counterparts. Again, is it a reality that the market's going to hold that way for 25 plus years where that additional interest just credit is paid out? Probably not at 777, but hopefully at least at the 663, since that's our marker. So I always like to show that side because I think it's a little more optimistic sometimes than when you look just at some of the other numbers, especially if you're seeing comparisons with the other tiers. That was a 35. We also did one at 57. The outcome was pretty much the same over the long haul. So of course the numbers went up because the balances were higher. But again, that's the piece that ultimately you guys need to get to, is what's potentially that projected balance. These, we all just use that same salary and assume that person made that same salary for every single year. So we did a pretty basic calculation, and we weren't giving them any increases from year to year. So that's really kind of all there is in a nutshell for you guys. Again, we have to pay into it if we're full-time. We don't have a choice. The law says if you're a full-time employee who works for a participating employer, we got to pay into this thing. And it is set up in a defined way in that, we don't make a lot of individual choices for it. So it's kind of a double-edged sword. A lot of folks just kind of forget about it because, the money comes out automatically. You guys, it's kind of the same thing with you guys. There's not a lot you can do to manipulate it, but you guys kind of have more of a vested interest in how investments are performing because that has a direct correlation to your benefits. And that being said, we post investment information every single month on our website. We do monthly updates, we do quarterly updates. So we have a huge section on our website that's completely devoted to the investment performance if you guys might be interested in that. So all of that stuff is available on the main KRS website. Yes?
I've heard in the past, some state employees, I don't know, where's it up that way or not, can we buy like this thing, we're not gonna hold out to make our years of savings,
Yeah.
can we buy out?
Unfortunately, the answer is no, and it's limited. If you'll look on page, let's see.
11?
Yes. The only things that you guys can buy back, you can pay back a refund. So if you had worked elsewhere, withdrawn that account, you can repay that to gain those years of service back and those contributions back. You can buy something called omitted service. Omitted service is basically full-time employment that you worked somewhere that should have been reported, but for whatever reason, it was not. We generally find that with part-time situations. What the law says is that it assumes, the law for retirement purposes says that if you're doing 100 hours a month, you're full-time for retirement purposes. And so you should be contributing. So we have a lot of part-time scenarios where somebody was hired to work less than, but over time, they started doing 100 plus hours. And that would be a situation that would be treated as omitted. that would actually change your tier level, because if that happened, say in '08, or it happened prior to '08, that would change you from a tier 3 back to potentially a tier 2 or a tier 1. Because we treat that as, it was membership service. You should have been reported in that capacity in the first place. We don't, you're not harmed for that. You pay it back in, you're made whole basically. The third is omitted with interest, and then the rest of those are tied to active military service. So unfortunately, you guys don't have the ability to like buy your way toward eligibility. You pretty much got to do the time. So again, that's the thing. Even if you do just a few years, what's that balance going to grow to by the time you're 65? You do 10 years, 15, 20 years. So it's just all relative. It's one of those things. When your employment situation may change, you go in and you crunch your numbers and decide what you want to do with it. No time frame on making that decision. You could just let it sit forever, and come back. So anytime anybody changes jobs, terminates their employment, there's no timeline at all on making a decision with respect to that retirement account. Because, again, I was a product of this. I left my job in 2000, and if you had asked me then, would I ever have been coming back to my same job, I would have said, no way, no how. 3 years almost to the day, I was back in my exact same job. So, you never know. You may go off to something else and things not work out, and then you get, you end up back where you were, back with another agency who's part of the system, and then you just continue accumulating to what you already had. So, don't ever feel any pressure to make any decisions with us is the good thing, because you don't have to. It's just going to sit there and continue getting at least that 4% from year to year to year, should you go inactive. So, anybody else have any questions? Yeah.
And I'm gonna apologize because I wasn't in here when you were
Yeah.
talking. Okay, so for my tier 3 folks,
Mhm.
the sick leave,
Yeah, sick leave doesn't count toward tier 3. Yeah. And the only thing that I can figure out, guys, your tier 1 and 2 folks, part of their calculation, their formula to determine their benefits is based actually on their years of service. That actually factors right into their formula. For you guys, years of service, we use it to determine when you're eligible to retire, but we don't use it to calculate your actual benefit. That's based just strictly on the balance. So when they created the tier 3, sick time doesn't count toward retirement the way it does for the tier 1 and 2 people, where unused sick leave gets them additional months of service credit, similar to sort of the purchasing. And I think possibly that's why you guys are limited on the purchase types too, because it doesn't really help the benefit so much, because it's not adding years. So, I mean, again, I don't know. The rest of it is that even with the other people, anybody who started after August of '04, purchases don't count toward their eligibility. They're strictly buying it as additional years, which gives them more money on the formula. So the ability to buy time to be able to use it to retire early, you had to start before August of '04 to do it that way. So, anybody else? So again, look for that interest credit. I'm guessing probably you guys would be safe probably if you logged in like at the end of September. You probably see that interest credit on your accounts at that point in time. There is actually when you log in, there's actually an account history tab that shows you the actual salary, but there's also a contribution tab that actually shows you the contributions and the interest credit. So you can see all that itemized on those accounts if you log in there. And there is a calculator, but you have to come up with that balance yourself. So, it's not the toughest spreadsheet, just spreadsheet times, 9% of gross plus the 4% is fairly easy if you wanted to project. But, or you could just make up numbers and say, well, what if it was this amount? What would I be looking at? But again, that will be available to you guys within the next couple of years, where you can run those projections out. So, and that's about all I have for you guys. Sorry you had to wait on your boss. I kept on, I was like, he's not turning around and seeing you guys. So I'm glad Kim came up and she was like, so.
I don't need much of a break.
Yeah. I don't think I realized he was on number 2 as well.
He is.
Yeah, some fortunate souls got out and got back in and got a second account. My boss is the same way, and
Yeah.
they're buddies. So.
Yeah, I can't remember what year did they pull that.
September '08 is when it stopped. So you had to have come back before September of '08 to start a second account if you'd already retired, yeah.
You know, there's so many people that are so upset about that. I'm like, there's not a single person that can complain about that would not have taken that option if that was their option.
Well, I mean, the reality is they, they still paid all their taxes.
Sure.
I mean, you know, and it was for a different period of time. I mean, how's it any different than, you know, earning another 401k account? I mean, I don't have an issue with it.
Yeah,
Yeah,
but,
so,
all right, well, thanks you guys. Amy, thank you so much.
well, you're welcome. Good luck. Safe, safe, safe.
Yeah.
You need to talk to your